Yesterday, we saw hotter CPI, we saw yields spike, then we saw stocks fall. How are you viewing what we saw yesterday? Was it knee-jerk, or is it a change in the markets that we need to pay close attention to?
I would say it's a little bit of pricing in some amount of probability that things may not go as well as the market had started to price in. I think a little perspective, we were up about 20% since the end of October in the S&P 500. If you look at the Magnificent Seven, up close to 30%. So a lot of good news had gotten priced in. Yesterday kind of shook us because you had what would be a bad outcome, which is, or what could be a bad outcome, which is wages inflation bleeds through to services inflation. That makes it so the Fed can't, cut rates and perhaps raises the odds of a recession. I'm not saying that's what's going to happen. What I mean to say is the market had to price in at least perhaps a little bit higher probability of that. And I think, maybe what you're seeing, at least to start today, is, hey, we put it a little bit of perspective, but it's one number, and we've had a long list of better numbers before this.
Okay, so it sounds like you're saying the markets are basically priced to perfection. So if we saw anything, any economic data that disrupted the narrative that the market was believing in, well, this is kind of the reaction that we saw. Gennadiy, I want to come over to you. Do you agree with that assessment? Is that things were kind of priced to perfection there?
I think so. I think it was a bit of a rude awakening for markets, if you will, that, the soft landing scenario is not necessarily going to be the only one we're going to get. And in my mind, you had the stronger data for CPI, you had stronger data for payrolls. Markets are starting to realize that perhaps maybe those rate cuts aren't going to come as fast and furious as initially expected. And I think that's been a big part of the performance of, equities, for example, recently, because they kind of assumed that the Fed would, come to the rescue in case anything weakened at all. If we get data strength, and this is kind of the question that we're asking ourselves, are we seeing a reacceleration in the U.S. economy, or are we just simply seeing more of the same strength? If we get a reacceleration, that really throws the narrative for a loop. Now, if we're seeing more data strength, then perhaps the Fed just pushes back those rate cuts and markets can still be okay. But, it's going to take a while to shake that out. And I don't think we're going to get a definitive answer one way or the other for at least the next few weeks.
Okay, so we don't have a definitive answer for a few more weeks. I want to ask you then, what should investors do right now? We got a report from Bank of America yesterday. It was their fund manager survey. They said it's the most bullish in 2 years. Cash levels now at 4.2%, down about 0.5% from the previous level. And they say investors are still all in on tech. But remember, we got this before that CPI report. As investors, how do you move forward after what we saw?
Gennadiy, no worries. I think I think there's a lot of investors waiting in the wings. They are trying to look for entry points. I think equities have been relatively expensive recently, so I think investors who have been waiting are now looking to see if this is a kind of a better entry level. I think on the rate side, which is more my focus, there's been a lot of investors waiting to buy those dips, buy the increases in interest rates. Because from a long-term perspective, these are good investments. The question now is, if we're not really seeing the soft landing scenario play out, or if we're seeing, higher for longer interest rates, should we be waiting even longer? Should we be waiting until 4.5% on the 10-year to actually get in? Okay. I think there's some investors dipping their toes, but I think it's going to take some time for markets to figure out if this is the time to buy in, or whether we should be coming in a little bit later here.
Speaking of that higher for longer environment, we had Double Line's Jeffrey Gundlach warning of the ongoing threat from higher for longer rates on CNBC yesterday. I want you guys to both listen. I want to get your reaction.
Interest rates were absurdly low, particularly real interest rates. And now real interest rates are reasonable. But I think that we have a problem with the amount of money we need to borrow.
All right, Bill, I'm going to give you the first crack at this. We're going to give Gennadiy the last word on the way out, go into his wheelhouse when it comes to rates.
So I agree with at least the beginning of it, that real rates are now reasonable, which is good news, frankly. I'd rather be back in a world that I view as more normal. I do think it's part of what I'll say is, I think you have to think when you're building a portfolio of having exposure to some parts of the market that may be a little less economically sensitive. Is really paid off to be piled up in the particularly economically sensitive areas. But think about, owning some healthcare, some consumer staples, maybe some insurance companies, things that just don't have quite as much of that exposure, I think, that is at least a place where they aren't as highly priced as they used to be relative. And so if we get into any sort of jitters, they should hold up better and help with performance.
All right, so Bill says get into healthcare and staples right now. It's a good time. Gennadiy, I'm going to give you the last word.
Sure. So from the rate side, I do think investors are buying in, at least some of the longer term investors. They are looking at this 4.3% yield on 10-year and saying, thank you very much. I'll put that in my portfolio and I'll keep that there for quite a while. The question in my mind is, I do share Gunlock's kind of question on additional deficits for years to come. We're going into an election where seemingly no one is focused on deficits. If you look at the CBO projection for deficits, they're absolutely atrocious, and they don't even account for the fact that we're likely going to see an extension of the 2017 tax cuts after the 2024 election goes through. So the fiscal trajectory of the U.S. is absolutely atrocious at the moment, and I am a little bit nervous that we may start seeing periods like August to October of last year where markets, we're seeing strong data,
right,
and they were starting to care about the impact of additional issuance and the fact that you could see a lack of demand for U.S. Treasuries where yields actually go higher. Now that's a pretty toxic combination when you think about it. That would really force markets to prove themselves in other ways.
But you're flagging the risk there. When would you possibly, in your mind, see that risk popping up for investors?
I think it would be probably heading into the election and perhaps into early 2025 when we see the trajectory for fiscal deficits.